to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Wesley Gray, author of Quantitative Value. After serving as a captain in the United States Marine Corps, Dr. Gray became a finance professor at Drexel University. Wes's interest in entrepreneurship and behavioral finance led him to found Alpha Architect. He earned an MBA and a PhD in finance from the University of Chicago. Let's ask him 5 good questions.
Welcome back, everybody. My guest today is Wes Gray, author of Quantitative Value. Hey, Wes, where are we talking to you today?
So you were talking to me from Broomall, Pennsylvania, which is a suburb just outside of Philadelphia.
Great. And let's jump right in. Question number 1. A big part of value investing studies seems to hinge on the concept of mean reversion. And it's most of these studies, the data points happen to fall in the 20th century when it was been a very improving time for mankind, especially in the U.S. So you kind of have this upward going slope, and then you have these periods where pessimism would come in and you could buy, but the slope was always going upward. What do you think that if the future is maybe a little more stagnant than that, maybe even a resource-constrained world, if you follow like Jeremy Grantham, do you think that value strategies are going to continue to do as well as they have previously, given that maybe the average is not trending upward as readily as it was in the 20th century?
So to clarify, so the mean reversion research and the argument for how that relates to the so-called value anomaly is started in that Leconstock-Cypher-Vishny 94 Journal of Finance paper. And just to make sure we're tracking what that paper is actually about, what they're trying to show is that if we sort securities based on price and on, for example, our x-axis, and then on the y-axis we post past 5 years earnings growth, you see a perfect relationship between past fundamentals and current prices, right? And their argument is, look at what the market prices in is some element of representative bias, where they are going to assume that things that have done really well over the last 5 years are obviously going to probably continue at some level like that over the next 5. And then obviously on the crappy cheap stocks, the reason they're crappy and cheap, as claimed by the marketplace, is because they've been doing a bad job over the past 5 years. Now, where the mean reversion element comes in is that over the next 5 years, we see systematic shifts in fundamentals where, these expensive securities that have been whooping it on for the last 5 years tend to do relatively well, but not as well as expected. And firms that have been doing terrible, i.e. these value securities, the next 5 years, they always end up doing a little bit better than expected. Now, and so how you make money with this, or why the value anomaly, quote unquote, makes money, is you're winning on expectational changes that really don't depend on a direction. All they depend on is an expectation change, right? So if you buy an expensive growth stock because its fundamentals are amazing, well, there's this thing called microeconomics 101, right? Businesses that are operating in places where you can earn an insane amount of money and have amazing earnings growth, they're going to attract competition. So we would expect that competition, assuming these folks don't have like ironclad economic moats, is going to create a mean reversion in fundamentals. And if the market didn't expect that, you would make money, on the expectational change, regardless of whether, the trend was up or down. It's all about the expectation difference that you bet on in the correct way. That's how you'd end up making money. And then obviously on the value securities, the reason that people argue why there's mean reversion in fundamentals is just at a real high level. If you believe in microeconomics and competition, if I'm in a crappy business, a whole bunch of people are in a crappy business, eventually, and those have really bad returns and really poor earnings. Well, competition will probably leave, and at some point, the argument is that, returns have to come back to some level where they at least cover like marginal cost of capital or whatever. So if you believe in kind of a behavioral story that markets have representative bias and they extrapolate short-term trends way out into the future too far, and they fail to appreciate, microeconomic competition, which drives mean reversion in fundamentals, the so-called value anomaly, even controlling for, exposures to different risk factors, is probably going to be around as it's been around for the past 100 years. It'll probably be around for the next 100 years. And we can talk more about why, and I think that would hold regardless of the trend. It's all about just the expectational betting, and being correct on the change in expectations is how you're going to make money.
So as long as there are humans involved, then we're most likely still going to see a value
I think
premium condition.
Yeah, I mean, if you look through the lens of behavioral finance, which is often misunderstood by market participants that don't follow kind of how academics consider behavioral finance, many people assume that behavioral finance is just about behavior. It's not. Behavior is one leg, but there's another leg which is called limits of arbitrage, or studying basic market frictions. And the old Friedman argument, is that behavioral finance, as most people assume it is, which is just about psychology, is bunk. And the Friedman argument is like, well, listen, if there's an idiot that is trading a stock that's worth 10 and he's trading at 9, as long as there's one really smart arbitrager, he'll go in there and bump that idiot out until it goes right back to 10. So when we look at pricing data, we'll never see an anomaly because, smart traders bump those guys out. So behavioral finance is about understanding, one, psychology. How do people make bad expectational errors? And then two, limits of arbitrage or market friction. So for the value anomaly to exist over the past 100 years and to assume that it's going to exist over the next 100 years, we need to know, one, the psychology mentioned. That probably ain't changing because humans are nuts. But then we also need to understand that the capital markets are not going to, exploit the anomaly down. And value in particular has really bad tracking error, i.e. you can get fired very easily by following a true value strategy. And, as long as there's a lot of separation of brains and capital and, and third-party asset management, which there probably always will be, value anomaly is going to be around for probably another 100 years, I imagine. People like to get fired.
That's good to hear. So question number 2, and this goes to the idea of always finding a good business to buy in an investment. And, Buffett and Munger have talked about, buy a good business and sit on your ass and it'll compound for you. And Joel Greenblatt systematically brought that in with, high returns on invested capital. One of the most interesting things about the book is that your findings show that the quality of the business really didn't have much impact, and price was one of just basically the primary driver. So if you to use Joel Greenblatt's his terminology, maybe the just broccoli business instead of the bubble gum was actually been a better investment. What do you think of that?
So I think a lot about it. And again, when you look through, when you think about sustainable alpha, we think through it through the lens of behavioral finance. We need to identify a psychology issue, and then we need to identify why there's not a lot of competition exploiting so-called, psychology issue. Now, quality, there is no psychology problem associated there, right? It's very clear that the market knows what quality is. Everyone knows Apple, Google, Coca-Cola, et cetera, et cetera. So at the outset, why would you ever think that quality would be a mispriced factor? It just is a standalone. And the answer is there's no reason why, because there's no psychology that would suggest you would mess that up. And then two, quality type stocks in general tend to have lower tracking error and fall in index. So there's no real limits of arbitrage or reason why, $1 trillion firm like BlackRock can't exploit it. So at the very outset, it makes no damn sense to incorporate quality as a core fundamental component, in the same level that you would consider price. Whereas price and the value anomaly, as we just discussed previously, is all about being buried in a behavioral finance context where the cheapest stocks are usually stocks on average suffering from some sort of representative bias, and so that they're mispriced. We think from a psychology problem. No one wants to own the stuff that everyone on CNBC says is stupid. And then there's also massive tracking error at those strategies. So you don't got $1 trillion firm saying, "Oh, let's go buy a bunch of value stocks so we can get fired next year." So that's just at a real high level. You always got to think, where are the idiots and why aren't other smart people exploiting them? And value investing in its purest form, just buying cheap stuff, makes sense. So what we found is that you've got to focus at the very beginning if you want to build sustainable alpha on just cheap, period. Ben Graham talked about this. Warren Buffett doesn't talk about that, but that's what he actually does. So if you look at that Fresini paper, Buffett's Alpha, it doesn't say that Buffett is a quality stock buyer, at reasonable price. It says Buffett he buys cheap, high quality, low beta firms. And you'll notice that the primary adjectives there was cheap. So Buffett can talk about a lot of things, but in the end, he buys cheap stocks, period. Ben Graham said buy cheap stocks, period. All the back tests and everything all the research we've ever done says buy cheap stocks, period. Now, once you're beyond that and now you're in the bargain basement of junk that is probably mispriced, there is some evidence that separating on, quality metrics and trying to identify which one's a falling knife and which one probably isn't, has a good chance of mean reverting on their fundamentals. It does seem to add value. And that's something that we do, obviously, and that we talk about in that book and that algorithm. That's something that obviously Buffett does explicitly. So we think that makes sense. But the magic formula construct is better for minimizing tracking error and keeping your job, but it's not, if you just want to go for the true alpha that's associated with the value anomaly, that's not how you're going to achieve.
Yeah, that's interesting. And I mean, I think part of it too might be just an institutional imperative of you have to sell what you're buying a lot of times to a potential client. And so if you're talking about all these dogs that have nothing redeeming about them as far as a business goes, people are naturally going to be, want to shy away from those. So adding that little quality component can give you a little bit more material for a sales job.
No, exactly right. And there's another great paper actually by not LeConstruct's on it, but Cipher and Vision 97 have a JF paper, Journal of Finance paper called The Limits of Arbitrage, where they talk about a lot of the problems with the agency model and asset management, where you as a value guy, let's say this stock's worth 10, it's currently worth 5. But you also know it ain't going to be a straight line to 10. It could go to 3 before it goes to 10. And if it does go to 3, you're going to lose all your assets because you can't convince your investors that this crappy stock you bought is actually going to go to 10. They're like, wait a second, you just lost 40, 50%. You're fired. And then, of course, it makes it even worse. And then when you sit ex ante, the managers that look at opportunities like that, they're like, wow, $5 stock selling at 10, but I know it could go to 3 in the interim, which means I would get fired. I'm not going to do that. I'm just going to do like much more benchmark hugging things. Yeah. And that's sole problem right there. Unless you can have the smartest asset managers in the world, but if they don't have the smartest clients in the world, it's all for naught. So one of the things we do, like our firm mission is obviously empower investors through education and make sure that we only get people that understand behavioral finance and are uber sophisticated. Because even if we're doing really cool things, we'll get fired when people look at our, vomit-inducing book stocks we own, which will inevitably blow up relative to the market for 2, 3, maybe 4 years even. But that's why those systems work.
Right.
No one else wants to do it, but that's a hard thing to sell to the vast majority of the public or even to professional investors because it just, that's not how you're wired to operate, basically.
Right. Like Buffett says, investing is simple, but it's not easy.
Yeah. Well, and Buffett's a genius because he got all his capital in permanent format where, he doesn't have to deal with, he can be really smart and not have to deal with idiotic investors, which means he can exploit, the value anomaly effectively. Right. And, God bless him. He did a great job, but it's pretty hard for guys like us to say, oh, yeah, I'm going to go start an insurance company. Can I have $5 billion? because we're not going to probably be able to do that. So,
Yeah, I'm waiting for that phone call still.
yeah, I'm still waiting as well, but it doesn't work like that.
Let's jump to question number 3. And this, in my mind, there is a continuum that I think smart investors sort themselves on. And on the one side, it's a very deterministic view of the world, understanding a business thoroughly, individual stock selection, very targeted. And then on the other side is, and that, by the way, that's kind of more the think like a business owner mindset. And the other side, you have think like a casino operator, where you're spreading your bets amongst what you think are positive expected outcome bets. You don't know exactly which one is going to be the winner. It's a very indeterministic view of the future, but you just know that if I buy things, with this certain classification, I'm going to do reasonably well over time. How do you... First of all, where do you find yourself on that spectrum? I'm sure maybe you've evolved, and as a lot of investors have. And what's the smart way if you're not sure where you should be? Like, how do I sort myself on there?
Yeah, so I've kind of been in those two camps, but now I've gravitated towards what I call this behavioral finance camp. So, I start off doing good old-fashioned stock picking, buying liquidations, trading penny stocks and cigar butts, and that whole game. Learn the business, the old good old-fashioned Ben Graham things. Made a lot of money, then got my face ripped off a few times, and I thought, maybe I'm not so good at that. And then, obviously I'm a Chicago finance PhD, which is like uber quant geeked out as much as you possibly can. And, so I've learned all that stuff, like differential equations and blah, blah, blah. But, in the end, I was also in the military as well, where I kind of got a lot more exposure again to the psychology component of how do people think and how do they make decisions. And then what I kind of gravitated towards was not like hardcore just quant and churn numbers for just because it's cool, or not just let's believe in this value religion of like doing your homework just because you think that's cool. Let's think of a logical construct to identify what we call sustainable alpha. And again, behavioral finance made sense to me because there's two elements. To look for real opportunities in the market, you got to identify poor investor psychology. Who are the idiots? Who is the dumbass at the card table?
Right.
But that's not enough though. You like the old saying is, if you don't know who the dumbass is at the table, it's you. In our opinion, in investing, that's not enough. You need to know who the dumbass is. But you also need to know who the smartest guy at the table is. And so in investing, we want to say, who's the idiot? But then who is the smartest guy at the table? We're not going to probably be him because we don't want to be overconfident, but we want to know where he's playing his chips. And if we identify situations where we see the biggest idiot at the table, we also identify that the smartest guy at the table is not exploiting said idiot. That might be an opportunity for us, who we're never going to be like, James Simons with math PhDs and all this, or trade insider information at SAC, SEC Capital.
Right.
So we just want to identify, the smartest guys at the table we know aren't exploiting this because for XYZ reasons, but we also know who the dumbasses are. So, we're just going to sit back in our little zone. We're not going to be $100 billion fund that does what, those guys do, but we're just going to be smart, kind of behavioral finance investors that find our opportunities where we're kind of the above average intelligent guy at the poker table, and we've identified the dummy and the brainiac. And we're just going to try to take advantage of opportunities that brainiac hasn't already taken advantage of.
That's a great segue into question number 4, which, obviously there's no lack of hubris in mankind and in the marketplace. And how do you know when you're dumb money, and how do you go about preventing that? How do you how do you know when you're on the poker table?
Yeah, I think in the end, when you read enough of the psychology research and the source literature, or even if you just read what like Dan Kahneman says, the thinking fast and slow guy who's like the best, done so many psychology studies that you can't even like count them all.
Right.
He even mentions that he doesn't trust himself and he knows about all the anomalies, right? I believe in the same thing, because when you learn about all the behavioral issues and the behavioral biasy problems, what's scary about them is you can know about them and still suffer from them to basically the same degree. So I came to the determination that I was just going to eat a massive dose of humble pie, and I'm just going to be purely systematic. I'm going to try to come up with sensible ways to exploit bad psychology that I know the big smartest guys at the table aren't going to try to exploit. And maybe it's not perfect, but it's going to be simple, robust, and I'm just going to have a damn computer do it, because I know, having tried to do the stock picking thing, and knowing myself and knowing the research in psychology, nobody can contain those things, in my opinion, period. Some people maybe are at the margin better, but unless you totally separate yourself, little monkey brain, from the decision-making process, especially when you're emotional and in the heat of battle, it just seems like a bad bet on average. So I just chosen to pull myself completely out of that process.
Huh. Yeah, and I think there's a good quote from Buffett about that. That it's like, paradoxically, when dumb money acknowledges that it's dumb, it's no longer dumb.
Yeah. Yeah, exactly. That's actually a great one. Once you realize you're completely full of shit, you earned a PhD in finance.
So let's do question number 5, and this has to do. It's a little bit more current about today's market. A lot of people are expressing that they're having a hard time finding anything that is historically cheap. There's just not a lot of value out there. You can find relative ideas, but in general, they're having a real hard time. What would you say to those people? Is there a systematic way to not necessarily use relative valuations, but instead to use a more still be systematic about it, but not have a systematic way to hold cash, I guess, is really what I'm looking at.
So we've done a lot of work on that, and frankly, we've probably done more work on asset allocation and market timing than we have on security selection, even though I wrote a whole book about security selection. And at this point, I probably back tested, thought about, or even had dreams about every asset timing, market timing scheme that you could ever imagine, from the most simple to the most insanely complex, like it gives me brain damage. And valuation specifically, like using any sort of valuation-based metric at a macro level to try to time markets, when you benchmark that system relative to, say, just good old-fashioned buy and hold, without even considering like tax consequences and trading costs, we have never been convinced that it works. And the reason I say that is the classic example that people I say is like, well, yeah, it was so obvious, obviously 99. We're at 99 percentiles on historical valuations. All we got to do is make a rule that historically, whenever the market gets to 99% valuations, we go to 50% cash, or whatever the rule is, some perturbation of this idea. We have data mined literally all of those ideas, and none of them are robustly able to beat buy and hold. And now, anytime you've data mined something and you still can't even find some things that sometimes work relative to the buy and hold element, it's very likely that it definitely doesn't work, at least in sample. So the natural question is, well, fine, that's cool. What does work out of all the things that you can look at? You can look at macro, like maybe you believe like oil, it matters, right? Because some people say, hey, oil shocks and oil prices, security analysts they're not able to incorporate that in their DCFs fast enough. So, if you have a massive oil shock down, that ends up being way more bullish for most securities than the market thinks. So that's a timing element. Buy when oil prices shock down, and then sell when oil prices shock up. And then there's some papers about this. Great story. Again, not robust. So, this is another idea that you can try, not just valuation. We looked at all these things. The only thing that actually works, in our opinion, at a robust level where you can throw every rotten tomato at the wall and you can still find, some element that this is probably a decent idea. And what I'm about to say is totally like I'm going to be a heretic in the face of value investors.
Yeah.
But again, as a value investor, I can tell you that you got to think about market timing. It's a total different science and a total different way of thinking about the markets. Trend following and momentum based models, such as say a long-term moving average like rule, where if the market is above its long-term trend, you just follow the herd. When it breaks, you get out. That stupid rule and other things similar to that stupid rule in the same vein of basic technical analysis are the only things that we know of that systematically work better than buy and hold. When you think in the context of protecting down like true permanent loss of capital, like your max drawdown. So if you do like trend following rules, sometimes academics, especially because they're so stuck on stupid with Sharpe ratios or looking at volatility measures.
Yeah.
They sometimes look about the same as buy and hold, but we obviously care not about volatility per se. We care about permanent loss of capital and 50% drawdowns. And when you think through that lens, and that's kind of what your objective is here, to avoid the massive face ripping jump off a bridge problems.
Yeah.
Those stupid technical rules, and I hate to say this as a value guy, are the only way that we know of to credibly signal when a guy would want to move to cash. Otherwise, just buy the cheapest stocks you can find, follow the framework, and then pull back to cash when you see some sort of technical trend breaking in the broader marketplace. That is a much more effective way of going about life than what has happened to a lot of value investors over the last 4 or 5 years, where they basically dragged ass on the index because they slowly went to cash and they haven't been following the trend, which was very strong and continues to be strong in the U.S. markets, where maybe it's not as strong in Europe. So, a value guy might want to actually be careful, because if you know a lot about macro timing elements right now, anyone who's got technical or trend following in their book, they haven't been in Europe. They haven't been in developed markets for the last 3 or 4 months, because those things are terrible, even though there's quote unquote value maybe at the stock level. So you buy your cheap stocks, and instead of going down, 50%, you go down 40%. Is that a good investment strategy? I don't know. That's arguable. Maybe it looks good relative, but
still a rough ride.
Still a rough ride. So there's a lot more to investing than just picking cheap stocks and using valuations at a high level market timing to try to time your cash and what have you. I don't know, man. I can't find any evidence, even though I would love to be convinced that someone can do it in a very reliable and systematic, empirically testable way.
Wow, that's great. I mean, that's probably what people need to hear sometimes. So the last thing we always do is a book recommendation. So
Sure.
What do you have for us today for that?
One of the books that really actually changed like my political philosophy and it made me think a lot is the book Nudge by Dick Taylor and Cass Sunstein. I came out of Chicago, so I was like uber hardcore libertarian, like, whatever, man. If you can't work hard enough and earn it, then you should just that's your own problem.
Yeah.
But then when you read that book, they kind of emphasize this idea that psychology is such a powerful thing that it can sometimes overwhelm straight up incentives. So if we're going to build decision-making frameworks, we should always give people freedom, because that's the American way, but we should at some level be a little bit paternalistic about how we frame decisions for people.
Yeah, the choice architecture.
Choice architecture is so important, because some people are not what the Chicago guys think, or like these hyper-rational, calculate 5,000 things a second, and they always optimize for utility. I'd love to believe that, but unfortunately, I finally got convinced by enough evidence, and I had to kind of change my thoughts about how the world actually works. And Nudge kind of literally inspired that whole revolution. It actually inspired our whole kind of investment revolution too, like to think through the lens of behavioral finance and not pure quant or just pure business guy. So that book was really influential on me, and I liked it. So
that's great. We'll have to check that one out. Hey, Wes, we really appreciate you coming on and answering our 5 good questions.
Yeah, Jake, appreciate your show, man. I think you're doing a great thing here, and look forward to helping in the future as well.
Great. Keep up the good work.
Cool.